Okay, good morning, good afternoon, and good evening to all of you who are joining us for this CGAP webinar. We are delighted to have you. We have stellar panelists that are joining us, and lovely to share with you today. We go ahead and get started, given that we have a lot to go through and we have only 1 hour. So welcome. Welcome to this webinar around rethinking finance to address the next frontier in food system transformation. Let's go ahead and get started. My name is Emilio Hernandez. I'm Senior Financial Sector Specialist, and I'll be your moderator today. A couple of housekeeping points, just so you know that we're recording this webinar, and we have a live stream in LinkedIn that many people are joining us through there. Your microphones and your video will be turned off. You won't be able to adjust that, but you can write your questions through the chat box at any point in time, and we will be closely monitoring them so that we can get to them at the end during the question and answers. And make sure your questions in the Zoom chat box are directed to everyone so that all participants can see the question and learn from them. Great. So I'll just go very quickly through the agenda that we have planned today. We're going to start with presenting you and kind of motivating and framing our discussion today with CGAP's food security framework. We really try to hone in on to what are the most pressing challenges in the food transformation agenda that we see, so that we, the financial inclusion community and the financial sector development community, can reflect on what type of interventions we need to do to influence and unlock financial flows into those priority areas, right? Where we believe there's a lot of innovation that is needed for steering those financial flows. Then we'll move to our stellar group of panelists. We have Suon Pisay from AMK Cambodia, Tessel De Jong from FMO, Alan Johnson from IFC, and Rob Messi from IDH Invest. They'll talk a lot more about the role in these organizations during the panel discussion. And then we'll end with a question and answer and some sort of conclusions that will come after hearing all of our perspectives. So let's go ahead and get started. I'll welcome my colleague Somya, who will be walking us through the proposed framework that CGAP is making on how to prioritize financial interventions for food security.
Hi, everyone. I'm Somya Banwari. I'm a financial sector specialist here at CGAP, and thank you all for being here today. So to kick us off with some background, we here at CGAP have been thinking about how the finance and investment community can best contribute to the food systems transformation agenda. And what we've realized on the way is that there are all these multidimensional pressing challenges relating to improving nutrition, sustainability, and livelihood improvements all at once, and that can create noise when one's actually trying to achieve concrete impact. And so what that brings us to is a suboptimal equilibrium in food systems. And what that means is, to start with, the robust public and private investment in staples like cereals over the past 50 or so years has increased productivity and reduced consumer prices for those commodities, which has ensured sufficient caloric intake for everyone. Though we do see pockets of severe food insecurity, this is the result of conflict, which warrant social protection interventions rather than food systems transformation interventions, while very serious. And we also similarly see strong private investment in high-profit agricultural value chains focused on high purchasing power markets. So think coffee, cocoa, avocado, and so on. And so this, as a whole, is really great progress towards solving one piece of the puzzle. However, what we've seen is that there's evidence to suggest that this isn't actually impacting the livelihoods of poorer households. And as I'm sure we've all seen, relatively lower prices for calorically dense foods can lead to a skew in diets away from nutritious commodities, both within the food processing industry and, across consumer diets. And this has led us to worsening malnutrition worldwide. And furthermore, smallholders receive a tiny and, in fact, a decreasing proportion of the value of the commodities that they produce, with the rest going to midstream or upstream actors. And lastly, current food systems, as we all know, do deplete natural resources and result in significant GHG emissions. All that to say, and this is critical, the lack of investment in more diverse value chains means that the actors within those value chains are not able to innovate or adopt technologies that can make those value chains more productive, and not just more productive, but more sustainable or more resilient. So then the question becomes, how do we actually diversify the value chains that do receive investments in a way that enables more affordable, nutritious food that is sustainably produced and that does offer benefits to smallholders and the workers within the agri-SMEs that are involved in those value chains? And there is a pretty decent size of work growing data and developing analytical tools to process that data with IFPRI and FAO as leaders in that field that can estimate which value chains have the highest impacts on different dimensions of food security, like livelihoods, poverty, nutrition, and so on. And those value chains can vary depending on the context, but often we see dairy, poultry, fruits, vegetables, pulses, commodities that serve local markets. And so increasing investments in those value chains, what we call high impact value chains, can maximize impact on nutrition, on sustainability, on livelihoods relative to other value chains that have received historically concentrated investments like coffee or cocoa or other cash crops. So once we identify those high impact value chains, we can then identify the bottlenecks that actually prevent higher productivity and sustainability, along with the right kinds of technologies or agtechs that can overcome those barriers. And so investing in those technologies can help, and the adoption of those technologies can change the unit economics that can make those high impact value chains viable and investable. So, to recap, what we posit is that the main way to achieve food system transformation is by investing in those transformational and high impact value chains. And so this fundamentally would mean a transformation in the technologies that we're using in those value chains that can make them more efficient and more productive. And luckily, what we've been seeing is there has been this wave of local agricultural technology solutions, what we call agtechs, that are being developed in response to these chronic bottlenecks that affect these value chains. So what we think about as local solutions to local problems. And we think about AgTech here very generally. So not just digital, but also processing, marketing, commercialization, extension, and so on. And so this momentum, this wave of AgTechs, can be leveraged for high impact value chains. And so we're starting to see those solutions begin to be created. So, however, despite the rise of these homegrown ag tech solutions, the challenge is that we're not really seeing them get adopted in the high impact value chains, especially the ones that are engaging poorer smallholders. And we see this reflected in the fact that total factor productivity in the ag sector is quite low and it's actually getting worse over time. And what global evidence is telling us is that the lack of adequate financial services is one of the biggest constraints to scaling the adoption of agtechs in these high impact value chains. And that is a tricky problem to solve. What we've seen is that formal and informal financial providers experience root constraints that largely explain that persistent agricultural finance gap. And so, taking a step back for a second, CGAP's past 2 weeks of landscaping with ag techs, financial service providers, and agri experts has been telling us that financial solutions in developing countries are not well suited as they are to broad ag tech adoption, especially in the value chains that we're talking about. And what we've seen is that there's a series of bottlenecks in the financial supply chain, starting at the top with wholesale finance down to retail finance, all the way down to the consumer or the borrower. And at the wholesale level, these bottlenecks, for example, relate to rigid terms associated with credit lines, guarantees that don't allow for tailored loan duration, repayment schedules, collateral requirements, interest rates, grace periods, and so on. And then down at the retail level, even well-capitalized financial service providers don't have the systems or the IT processes or the specialized staff that can develop and tailor these financial products per value chain. And addressing that requires substantial R&D, and substantial R&D requires substantial resources and external support, especially when they could be serving wealthier and lower risk sectors that offer a higher return on their time. So altogether, these bottlenecks mean that financial services are not well tailored to the needs of actors in high impact value chains. So to recap again, there's an unprecedented opportunity that we're seeing provided by the digitization that's happening in the finance and ag spaces, reflected by the emergence of new data stacks that are being generated to better manage the risks of lending. For example, new data sets, open data frameworks, open finance frameworks, satellite imagery, all these tools and others that can lower the cost of customer acquisition, monitoring, and making lending viable. And we think this gives investors an opportunity, in fact, to first identify the value chains that do achieve higher impact when it comes to different relevant dimensions of food security, and then looking at the transformational technologies, the ag techs, that support those high impact value chains to become more productive, more sustainable, more resilient, and so on. And then focusing on financial innovation, financial products, and so on, and the surrounding financial infrastructure that supports those ag techs and those value chains. And all of this allows us to better focus scarce resources to maximize impact in food systems transformation. And CGAP's role in all of this is that we're trying to contribute to identifying the specific solutions, testing examples of this in practice, identifying innovations in financial products and ag techs that can better manage risks and reduce costs and so on to achieve better impact when it comes to equitability, nutrition, and sustainability in food systems. So with that, I'd love to pass the baton to our panelists to hear about their own work and their philosophies in the space. So thank you so much for your time.
Thank you, Somya. Indeed. Now we are going to start a dialogue with our distinguished panelists. We will start first with self-introductions. Basically, I'll ask a question, and when you respond this first question, please just, I've already mentioned your name and affiliation, but if you could just mention your role in your organization, that'd be great for our audiences to learn. So the first question, it's a general for you all, and it's what promising initiatives would you highlight that your organization is promoting that unlocks finance for more diverse local ag value chains with high impact in nutrition, in sustainability, and in livelihoods? So perhaps we start with Suon.
Yeah, thank you so much. Good evening, everyone from Cambodia. It is a privilege to join the important session. I'm very excited, that today we are talking about unlocking finance for agriculture value chain with high impact on the nutrition, sustainability, and livelihood. I think my name is says I'm the Chief Business Officer at AMK. AMK is the microfinance institution dedicated to provide the financial service to various segmentation, particularly to smallholder farmer and agribusiness. So in AMK, we recognize that I think financing local agriculture value chain is in the country, especially the low or middle income country is crucial. I think for transform food system, improving the livelihood, and so on. So from my experience, I think access to the finance alone is not enough for us as the microfinance. So agriculture, I would say that is the high risk sector. So the smallholder farmers face a lot of challenge. So such as, limit access to the finance, high climate related risks, and unstable, the market condition. I think all of them will make them difficulty, to invest in sustainable practice and technology. So I would say that the MFI cannot stay as the just on the lender anymore. I think we have, to move beyond of the financial service and become the active, partner across the whole value chain. So, for AMKs, we learned that I think the farmer is a struggle that not because of the lack of the access to the finance, but I think because the lack of quality of input, technology support, and reliable, buyers and the market information. So I think we have to start to reshape the way that we engage to the agriculture sector. So I think AMK, start doing a lot of things. I think since we experience over 20 years with, the farmer. So because of that, I mentioned, I think the finance is not, enough. I think we are, doing to recruit the agriculture specialists, to have the farmer. So we're not, to for only lending, but I think we have, the staff that they have the expert, to do their job, work with the, group of farmer, corporate, agriculture cooperative, and then link all of them, to the agri value chain. I think to find, the expert for them, to share the tip, the agriculture practice, and so on and so forth. So this is the way that we are doing right now, and then we develop, some app, the agriculture app, to support all the whole supply chain as well. So I would say that I think, when we say about financing to agriculture, I think it's not, only about the providing the loan to the farmer. I think it's this a build ecosystem. It is about the ecosystem building, and I believe that MFI or the banking or financial institution must take a lead in connecting all the players across the value chain.
Yes.
Thank you.
Thank you, so on. I love your concept of the financial institution being an active partner along the value chain. We'll discuss a lot more on that in the follow-up questions. We move on to hear the perspective of Tessel Young from FMO.
Yes, thanks, Emilio. And Swan, fully agree with you that it takes more than finance to make a business thrive. So my name is Tessel Young. I work as Technical Assistance Officer for FMO, FMO's market creation team, in which I focus on the agribusiness sector. For the ones that don't know FMO is the Dutch Development Bank. We provide debt, equity, guarantees, and grants in emerging markets. We focus on 3 different sectors: financial institutions, renewable energy, and agribusiness, food, and forestry. For us, agribusiness is everything that is food, grows food, processes food, produces food, and sells food, just to make that clear. And the promising initiative is actually the setup of this team that I'm now part of. Market creation is part of the updated strategy, so the Pioneer Develop Scale strategy that FMO set up 2 years ago now, which really focuses on progression. So how can FMO support companies across the capital continuum, let's say from the far left, starting with grants, all the way up to mobilizing commercial funding. Market creation is on that far left part of the capital continuum at the pioneer stage, aiming at supporting or transforming unbankable or uninvestable businesses into bankability or investability, creating short-term and long-term pipeline for FMO and other impact investors, thereby also supporting the ecosystem. So whenever FMO is not able to make the investment, we hope that other impact investors are able to take it up. Due to our ticket size, which generally starts at between 10 to 15 million, but also the fact we have limited availability on the ground. We have always worked with intermediaries, especially for agri. So we work with large-scale traders, we work with local FIs, MFIs, we work with funds such as AREF, but also IDH FarmFit, as well as tech-enabled aggregators such as Babangona in Nigeria, to really reach, let's say, those actors that you were linking to, Emilio, that we cannot serve ourselves directly. The reason for the market creation initiative is actually that we see increasingly the need, both because of impact, but also because of the number of investable businesses that are actually out there for that ticket size that I mentioned, that we need to shift downstream and really focus, for instance, on those local processors that play an important role in different value chains that they're in. But also to say that many of these businesses are not investment ready, or they're not bankable yet, at least not for FMO or for the let's say the common impact investors. And this is where market creation comes in. So under market creation, we are able to provide pre-investment TA to help build those core business skills. Can be financial structuring, can be ENS, can be monitoring, can be middle management support, to really help the business strengthen, to be able to take up the funding that makes them scale. the other side of that is that we're also able to provide catalytic finance. We call them repayable or convertible grants. For instance, for CapEx, if we look at agribusinesses, to help them scale to meet that ticket size that we are eventually looking for. Obviously, this is a long-term process. We've been doing this now for 2 to 3 years. It's not easy and it doesn't happen overnight, but we increasingly see the need to work with different partners, both, let's say, upstream in terms of donors, funders, governments, as well as partners on the ground, which are our funds, but also banks and MFIs, to see how we can continue to provide that access to finance for agri actors across the value chain.
Thank you, Tessel. So just highlight the fact that you're emphasizing the need to create technical assistance components, even within organizations like FMO, to build the capacities of your future investees, right? Now we move to Alan Johnson from IFC. Alan, would you like to share that aspect that you'd like to highlight about how to unlock finance to local ag value chains?
Sure. Thanks, Emilio, and thanks for the invitation. So my name's Alan Johnson. I work for IFC. I'm on the agri-business advisory side, so I'm not actually from a direct finance, although obviously IFC-F is the finance part of it, and IFC is part of the World Bank Group. In fact, we're going through a very interesting transition as we speak, where parts of our organization are going to be merged with the World Bank. So that'll increase efficiencies in some areas and actually change, some of the perspectives, I think. And I think it fits with what I see as we already have an emerging theme, which is around looking at these grand challenges, if you like, in a more holistic way and not just looking at one specific dimension. So I think, greater work with the World Bank will actually enable us to look more widely at some of these challenges that you've highlighted. So I think what I want to focus on is actually this idea of trying to intervene intentionally with an instrument like blended finance. So I'm very, I was attracted to the subject area of this, food security, nutrition security, sustainability. So I think we have and are still trying to, I guess, guide investments to achieve sustainability outcomes, to achieve better nutrition and to achieve, better livelihoods. I think we'll get onto this later, but in practice, it raises the idea of, can you actually meet all of those sort of objectives simultaneously? And are there trade-offs which we need to be aware of as we, try and achieve those objectives? I think the other point I want to maybe get into a bit later is exactly, it's been raised already, but this idea also of these things don't just happen by magic on their own, and to what extent do you need to have some sort of supportive, whether it's TA or other kind of support infrastructure around them. And I think, there's a focus in the presentation earlier about ag tech. I think that's a great example of just because you have a cool innovation doesn't mean that people are going to use it. There's a whole other set of issues around why it is that technology is or isn't being used. And I think, unpacking that, and then some of those challenges, may not be things which are amenable purely to financing and pricing and may need other kind of interventions, complementary interventions as well. But anyway, more onto that later, but that's me just to get us going, Emilio.
Thank you, Alan. Excellent. So yeah, I really love your point around in this process of being more intentional, we're going to have to get very strategic in terms of what trade-offs we face and making decisions about those trade-offs, right? To aspiring to maximize our impact, right? That's a great point. And last but not least, Ro, would you like to come in with your main big picture pitch?
Yes. Well, thank you, Emilio. My name is Ro Messi. I'm the CEO of IDH Invest, which has two parts: investment development, focusing on early stage working with grants. And we have IDH Investment Management, which is we manage the Farm Fit Fund and the Farm Fit Fund, and we're advisor to One Acre Ventures, connected to One Acre Fund. The FarmFit Fund is a fund that is 100% focused. It's a blended finance fund that tries to demonstrate that you can finance, that you can do farmer-related financing on a financially sustainable basis. And for that purpose, we're building up a portfolio whereby our primary focus is to catalyze others, and we do that by using high-risk instruments such as subordinated loans, guarantees, and in relation to innovators, agtech, fintech, we invest with equity alone only. Very much agreed to previous speakers that financing isn't by itself is not sufficient. It's part of a bigger ecosystem, and market linkage is important. Technical assistance and investment readiness is a big challenge. But also because it was addressed by other speakers, I would like to focus on something else and also answering Emilio's question: what is the most promising innovation that you've seen? And I would say that in food value chains, what you see is that a couple of things are lacking. There's usually a bigger diversity of crops, so you may not have the same uniformity as you have in the cash crops. Also, aggregation may be more of a challenge as a result of that. So often it's on the level of a financial institution. Sometimes you have agribusinesses or social enterprises like a One Acre Fund, Babangona, etc. But usually that's not the case. So it's very diverse. So that also provides kind of a problem. So this diversity, not only in terms of credit metrics, but also different actors. You see a number of challenges, as also indicated in the report. There are financial products that are not fit for purpose, ineffective credit criteria. Certainly when it relates to banks, of course, everybody will recognize that collateral-based lending is not the answer to the problem that we're facing. And of course, the lack of value chain integration. And as a result of that, we lack scale. So what to do? We have, with the FarmFit Fund, we made 2 investments, which can be part of the solution. And it's on aggregation of lending, but also above the level of the loan originator. The loan originator can be an MFI, can be also a value chain actor, can be basically anything. So talking about white label financing products, we've invested in a company in India that's called Avanti Finance, which connects the big pools of capital that are available there with smaller organizations that connect to smallholder farmers. So they provide credit metrics, they provide the loan product, and of course, towards the investors, they have a dashboard on the portfolio and the investments that the banks are making. And the second one is a company that is also, I thought it's quite promising. They are partially the same. They provide a very strong credit scoring model that is developed also with AI, and that gives much better outcomes than what you usually see in the market. So to give an example, right now the MFI sector in India is going through a rough period with PAR 90 above 20%. With their methodology, it's let's say the results are getting worse, but it's still 4%. So there's a huge difference. But what is the most attractive part is that through securitization models, basically you aggregate the loans. You're not financing the agri-SME, so you separate the risks from the loans, which are scored through a proven methodology, and you make the predictability of the loan portfolio, you make it much bigger, and with that make it investable to more mainstream investors, also including commercial investors. And now that model is being duplicated replicated to East Africa. And of course, there it's still in an early stage. But if that works, you overcome the problem of subscale originators, because you bring the loan products to a higher level, and the originators can then they can issue new loans, which then also will be invested in by banks, by even institutional investors. So that, even though early stage, I think is a very promising development, because it applies. Doesn't matter which supply chain, which originator. It can also be on a very solid platform that over time can gain acceptance from institutional investors and banks.
Thanks. Thanks for all that. That's a fascinating point. I'll just so what I highlight there is the approach of kind of getting to this white label kind of loan products that aggregate the loans going to smaller retail financial institutions that are hard to serve. Have been historically hard to serve by development finance institutions. And I'm sure that leverages a lot around the digitization process that has been increasing in the financial sector, as well as in the agribusiness that Somya was referring to in her presentation, that enables that aggregation and that homogenization of serving a lot of small lenders. Thank you. So this is great. So let's get into a little bit more details. You've given us a sense of the big dimensions that you like to highlight, that overall together illustrate all the different tools or potential tools that we can use to solve the big challenges that we've discussed. But going a bit deeper, we'd like to go back to Suwon and ask more specifically. You mentioned that AMK really has become a market actor facilitating agricultural value chains. In what way have you done that, and how exactly have you managed the risks of lending to local agricultural value chains when you have so many different types of risk: climatic risk, production risk, marketing risk, and the credit risk itself? What are some of the most effective approaches that AMK has done to build a large agricultural loan portfolio with local value chains?
Yeah, thank you so much, I think, for this question. Yes, we I think because of that we work with the farmer. I think we understand the risk of the farmer. I think the production, the biggest challenge of the farmers is the production risk. So I think many farmers struggling with the poor of input quality, somehow degrade the soil, or update farming method. To be addressed on that, I think AMK is trying to support the farmer. We employ that I mentioned earlier. I think the agriculture specialists, I think, who work directly to the group farmers, to the cooperative. I think the main task that they work, I think, to ensure that the farmers access to the quality of the seed and fertilizers, and also the input from we would say that I think reliable the suppliers. And for us we a bit easy, because we have some supplier are also AMK customer, and some of them is the partner of the AMK, so we can link them into link them with the purpose together. So I think it's the one thing. So I think our specialist also to work with the farmer to advising farmer to especially on the land preparation, soil improvement, and crop selection, and also to provide the technical support to the farmer, So we believe that I think we need, to make sure that I think farmer well prepared, and then we support them to hold into entire production cycle, start from, planning, to harvesting.
So
So also,
can I just probe you on that? So that means that AMK has built internal capacities to first understand what are the issues in the different agricultural value chains and the farmers that you work with. When you say we know that they're losing low quality input or they are not using good agricultural practices, that means that you have knowledge, creating internal knowledge to assess that, and then figure out how can I facilitate better access to better inputs. Is that a fair assessment? That implies an investment from the financial institution side.
yes, I think that's correct. That we see, but I think all us we don't have to be the expert on that agriculture honestly. But I think because of that, we work with the farmer. I think we understand that the challenging. That's why I think we try to invest to recruit the specialists to help us, because we will not rely on our sales staff. I think to meet the farmer, and then they have skill with the financial financing product, not skill in the risk, the agriculture risk. They may some know, but not deeper. That's why that's why we recruit them, recruit the specialist to help. And then also not they do directly from themselves, because we cannot to invest huge the number of the specialists to have all 1,000 cooperative across the country. So I think we recruit them to link with to cooperate with the NGO that they have the program on that I mentioned, to share the best practice, to have the expert on the soil improvement, land preparation or so on, relate to the whole the production cycle on that. So this is the one thing that I think we're looking at this, and then to improve on that, to improve the quality of the farm, and also the farming best practice. So this is the part of that I think we manage the risk. So when the farmer, they understand on that, I think they start to change the way that they produce their crop, the planting their crop. I think with the the quality, I think is the good for us as well in terms of risk. So second, I
Now,
think
just to say, so in that process of you developing what you describe is a strategy of building some internal capacity or knowledge around ag, and then being able to partner with different agribusiness actor players like NGOs to provide the right support to your customers. Now, along the way, we wanted to ask you how the process of digital technologies have that been helping you in scale this approach that you have? In which ways have you leveraged digital technology either to serve the farmer directly, either to link up with partners, either to get more information that allows you to assess risk better, or maybe provide agricultural insurance?
oh yes, I think we AMK invest to develop our own app that we call it agri app. The name is the Tunlesat. You can now available in the Android, or or iOS. So you can download and see the Tunlesat app. So the Tunlesat app can leverage all of that. I think we bring the farmer, and we bring the buyer, supplier, input supplier, and also to linkage on that. So we also including to advise from the expert. I think we coordinate. Fortunately, we can cooperate with the expert from the Ministry of Agriculture, that they can share the tip or the guidance regarding to agricultural practice. So in this app, the farmer can link to to that platform, and then can connect to the buyer, connect to the processor, connect to the to the the input supplier, and also connect to the technical support. To have them on the entire production cycle. When they have the problem, they can use that to communicate. So this is the app that I think we leverage to manage the risk, and also to help the farmer to improve their production, or to help them when they have the problem on that. So in this regard, we also link all that. Also, that you mentioned insurance as well. That I think we work with the partner to provide the weather index insurance, that I think the farmer can purchase the product to protect their crop when they face the natural disaster, flood, drought, so on and so forth. So this kind of that, I think that AMK developed on that to manage the risk, to leverage our digital solution, and to manage the risk as well.
Thank you.
Yeah.
And I would say that there's a lot of backend in that technology, because I imagine it implies integrating into other people's systems, right? Agribusiness systems, government systems, or receiving data from them and being able to upload that data and share it with your farmers. So that's a great way, a great example on how you're leveraging digital technology. Thank you, Swan. So we'll move now to Tessel, where Tessel, you were highlighting the importance of really an organization like FMO investing in creating a market creation program that actually focuses on doubling down on technical assistance to potential investees to build their capacities and make them more investable. So what are the good practices that you found to effectively build that capacity? You mentioned it's probably a long-term gain, but what do you feel is the edge of your strategy to be more effective?
So if we focus indeed on those good practices for local financial institutions, MFIs, FIs, I think Swan has mentioned, a lot of that actually revolves around knowledge of the sector and knowledge of the value chains, knowing where you should be playing or probing in that sense. I think financial institutions, including our own, focus on risk. So in order to diversify the segments that you're currently supporting and moving into agri or into local agri value chains, you need to focus on managing and mitigating that risk, right? Let's say on the financial side, we work with two different tools. So one is guarantees. I'm going to assume that everyone kind of understands how a guarantee works, just for the sake of time. We have a Nazira, the Nazira facility in place, which is a guarantee facility funded by the EC, which takes up the second loss guarantee or provides a second loss guarantee that we can extend to our FIs, specifically focusing on underserved segments. So that includes agri SMEs, but also women-owned or women-managed SMEs, young entrepreneurs, anyone that's basically for who it is hard to find collateral, could be covered under the guarantee. So that's financial risk mitigated, and then those guarantees often come with TA, and this specific guarantee actually also comes with a technical solution. So if you then get this guarantee, then you still need to manage the portfolio and show the donor or the funder that you're actually using the guarantee for what it's meant for. So serves, let's say, the reporting side of it, but it should also serve to build confidence with the bank or with the FI that these, let's say, underserved segments or these clients that you have are able to repay. So they're able to serve the loan in order to build confidence that you can actually work with these segments. That's also, I think, a bit of a connection to the technical part that you were referring to earlier, that is actually an important game changer in all of that. Now, the other side of building capacity with the bank is actually building capacity with the SME that is getting that loan or getting that credit, right? An example of how we're doing that is that FMO is part of the CASA program or CASA Plus program. You might know the name. It was a program anchored by FCDO, I think about 5 years ago, together with a number of investment partners, including FMO and BII. Focused is very implemented by TechnoServe, focused very much on post-investment TA to increase access to finance for inclusive agri-SMEs. So really focusing on the smallholder part of all of this. Since at the same time that FMO launched its market creation strategy, we added another segment to the program, so to the CASA program, making it CASA Plus, which also focuses on the market creation side of things. So what are the barriers to invest into those agri-SMEs in those smallholder value chains? We focus on Nigeria and Tanzania, looking at all the segments that we're working on. And for the financial institutions, we see that the barriers not only lie with the capacity in the bank, but also very much with the capacity at the SME level. So we're providing capacity building at the bank level with ASELI, which also provides a financial incentive to that end. And TechnoServe is the implementer of or the TA provider at the SME side of things, in order to make sure that whenever money is taken up or credit taken out, it's used for the right purpose. And there is again, let's say that proof developed that these are SMEs that are actually able to take out the credit and serve the loan. Just to say that banks are not the easiest to change in that sense, or to move, let's say, to other segments. Working for a bank myself, I can fully constitute to that. But I think especially this combination of capacity building at the banking side and capacity building at the SME side helps also to have our investment officers see that this is actually what is moving the bank along, right? So it's not only about having a strong agri strategy. There is a large part, I think, especially in agri-finance, around knowing agri and understanding the value chains you're trying to serve, because it's not general SME finance, but also putting time and effort into and capacity into helping those SMEs making the most out of the loan that they're are expecting to serve is really helpful. And I see, so we started in Tanzania, but I definitely see uptake already across East Africa and other regions to see how we can further build this out.
That's a fantastic point. So basically, it really resonates with our experience. So you're basically saying, when you talk about TA, let's get a little bit more nuance around that. It really requires support to the actual customers, the SMEs, the ag SMEs, and the ag value chains. But your financial institutions require TA because they need to build systems, knowledge, capacities that if they don't receive support, it's very hard to justify. I mean, I've had very hard conversation with boards of microfinance institutions that, they see a very successful pilot, but to scale it, they'll need to make significant investments in terms of core banking system, MRV systems. And the second point, the second nuance that you highlight is also how much you can now do when it comes to MRV systems, the monitoring, reporting, and verification system, to systematize them, to really make them easy to collect the data and get the evidence that these new customers that financial institutions have not been serving before are becoming bankable, are becoming a profitable segment over time. I think that's another aspect that's very new, right? Thank you for that, Tessa. We'll move over for now to hear Alan. Alan, you mentioned very interesting aspects around the work that IFC does in creating units like MAS, which actually are meant to provide technical assistance. So that's a big acknowledgement that finance is not enough. And you were mentioning in that process the challenges of trade-offs, right? When we want to be really intentional about impact and recognizing that today's challenges are so multidimensional, there may be trade-offs between focusing on just environmental sustainability or just nutrition or just livelihood improvements. Maybe you'd like to expand on that. How is IFC managing that?
Well, I think it's interesting. I mean, one thing is to look at the kind of evolution, which I think you pointed out. You know, originally we were food security, we were just chasing productivity and calories, and then that morphed into a wider, more holistic concern. Then we have the sustainability agenda. So I think it is definitely legitimate to aim at all three. I think so just to make it very concrete, I've been working on a sustainable rice project. And why rice is chosen is because after livestock, it's one of the biggest methane emitters. So if you want to do something about climate in agri, you know, rice has to be one of the things there. So rice cultivation is also highly correlated with poverty in Asian countries. So you've got a livelihoods aspect to it. So in our program, at least, you know, we feel we're really, you know, pushing on the farmer livelihood side, and because we're targeting GHG mitigation, you know, we're also hitting that. But of course, you've got the three prongs, and I'm still, you know, the jury's still out about rice as a sort of nutritious food. Well, in fact, it's not. You know, it's got all this problem with links with vitamin shortages and glycemic index spikes and all this kind of stuff. So there are, you know, mitigants even to that. There's low GI varieties that have been developed. There's issues about how much milling you do of the rice and how much, you know, how much content is taken away by milling, which makes it look nice, but it becomes less nutritious. So that's what I mean. The complexity sort of starts getting in there. But to me, then there are a couple of sort of takeaways from that. One is the importance of looking, you know, holistically at the whole chain, because then you're also then looking at the milling and the processing as well as just the farming, because you can't just isolate one piece if you're trying to look at sustainability impacts overall. And then I think that does have implications for kind of the targeting. And I think the other inescapable conclusion for me is that even a single institution isn't enough. You know, you really need to build a partnership around this. So we've been working a bit with the World Economic Forum, who are trying to do this. It's called the First Movers Coalition, where you try and get some of the big ag companies to make, you know, commitments to procuring sustainable commodities, as an example. But it's, you know, so that's one sort of stakeholder group you need to build up. Then you need to work with the millers, and then of course the farmers. So it does, you know, I think more and more we need to look at these things really in a much different kind of way. And then just I realize we're running out of time. So the other big sort of issue for me is the kind of short-term, long-term dimension, that a lot of the times we're chasing very short-term ambitions. And if you look at an agenda like regenerative agriculture, that just simply doesn't fit with what we're trying to do, you know, like having big increases in productivity over short periods of time. What I would say, though, is that in your report, you identify nicely that I think technology has to be part of the solution. And I think one of the things is exactly, you just mentioned it, the whole MRV. And if you can actually learn or have knowledge of what's going on at a much more granular, real-time level without spending huge amounts of money on it, then I think you can begin to see through the chain what's working, what isn't working, and, you know, really sort of take action at that level. So, I mean, although having said it, we're facing a much more sort of complex set of challenges, that on the positive side, we also, you know, we're more aware, we have more technical solutions. And so, you know, I think it's how we navigate with these advantages, but recognizing the challenges as well.
Absolutely. Thank you, Alan. So yeah, no, that's actually, you know, a very good point about you know, the trade-offs and how you know, focus some there are different interventions to achieve sustainability, And there are trade-offs even within those. You highlighted movements around regenerative agriculture versus technologies that reduce greenhouse gas emissions. They're all contribute in different ways, and there are challenges to their adoption. Thank you. And we move to Roel. Roel, you mentioned something very interesting around how you've seen and identify partners that can help you both aggregate, let's say, loans to financial institutions in different regions or countries, and also create better credit scoring. That sounds to me as extremely technological based, right? What is enabling now versus 15 years ago the emergence of these approaches? How do you actually, what do you think are the enablers to create a white label aggregate loan product and the credit scoring techniques that you've seen can really make a big difference?
Yeah, thanks for the question. Yes, technology plays an enormous role. We also seen in other examples of our investments, there were other providers of credit scoring mechanisms, which I thought were very low tech. I think that we'll move on in terms of sophistication. I think the positive part of this is around you're creating distribution apart from setting up new distribution methods. Of course, we also see a lot of platforms like service platforms that also include financing to farmers, which need some kind of a physical interventions like village entrepreneurs, field agents, whatever they are called. And you see that the bottleneck there is also the runway to become profitable, because these are quite expensive models, but they could be feasible. But here, I think it's very much about the technology. It is about, let's say, the methodology of credit scoring, product development, but also creation of big data pools. And so one of the companies that I mentioned initially is called calorie-focused, and the data set on which they are basing their credit scoring are huge. So it is very critical, and the methodology around taking the right data, because you're talking about maybe 30 data sets, which are huge pools of data that are available, but how to apply those. And that, I think, is the big trick here. I think product development, yes, important as well, but I think here, let's say, your data analysis, that is key. And then coming to the local, call it distributors, they become more dependent on the methodology, and of course, their contribution is the connection to the farmers. But the diversity in terms of quality, how they approach farmer financing, is not that big anymore, right? Because everything is uniform, is proven, creates, of course, the data sets for credit scoring are important, but also after that, you create a pool on what works and what doesn't on a much bigger scale than previously was possible. So in the end, yes, it is about technology, proof through data, and through that also incorporate tap local capital markets. And I think that would be maybe a few steps ahead, but not that much in it.
So just connecting some of the points, Roel, that those investments in terms of getting financial institutions, both let's say at the retail level or at the meso level, that are aggregating to leverage the new data sets that are emerging, the new digital analytical tools that are emerging, requires an investment. And that's where potentially some of the technical assistance that Tessel and Alan and Swan have been implicitly talking about can also support to accelerate, right? Because this requires enormous investment, right?
Absolutely. I think it is also essential that the parties that are are present here, they collaborate, in particular on the models that allow for or have large scaling potential and transformation potential.
Right. So I realize we are out of time, and we have a couple of questions, but I wonder if I could just share with you some of the questions that we've received. One question in particular to anyone who would like to respond, but maybe this is more associated to you, Swan, is as a strategy to enable the viable distribution of agricultural loans. How can you merge or bundle? We heard a lot of bundling of services, financial services with other non-financial services to reduce the cost and kind of distribute them using the same distribution channels, such as agri-agents or and the sort that can lower the cost of serving the customer. Have you used this type of bundling strategies? Is this a promising approach in your experience? You're on mute, Swan.
Okay, sorry. Yeah, I think for AMK we have, I think because of we not only the MFI, I think we have other service beyond the credit. So I think it's good opportunity for AMK to bundling our product beyond the credit product to the customer. I think can help us to leverage off of that, and so I think because of that we develop on that we call the payment system on that the mobile app that we call AMK mobile app. So I think our customer when they borrow money from AMK, and then they can open saving account, so we can put the money from disbursement to the account at that, and then they can perform transaction. So in this regard, they can use all of that money to pay that. So we link all the supplier, the aggregator in that platform, and then the customer, they can pay without fee charge. So I think this is the part of that, I think, to reduce the cost for the user, and also we can attract on that from not only to provide the get the interest from the loan, but I think we also have the saving balance to use, and also to use the fund, and also to charge or something fee that we put in the ecosystem. So this is the part that we leverage that to making sure that I think we invest the digital solution, but I think not really increase direct or indirect cost to the borrower because of that.
Thank you, Swan. Very interesting. And maybe the last question, it's around the fact that there's a question, actually, I think this is to Tessel, directed at Tessel. How does investability look like for FMO? What makes an AgTech or an agribusiness investable for FMO?
Yeah, that's a very good question, and probably not one I can answer on the spot, because it really depends on the business itself, right? So maybe to add, FMO has a team, the ventures team, that specifically focuses on tech-enabled SMEs, or tech SMEs in that sense, under which we do fintech, edtech, and agtech. So we are able to invest directly into agtechs. It's a very small pool. I think we started around 500,000 up to 2 million max. Mostly equity, can be convertible notes. depending on the company. Again, there are a number of things that matter. I think let me mention probably the most important ones. One is, and this is the biggest difference, let's say for ventures versus the rest of FMO, is this tech or is this tech enabled? And there's a big difference between SMEs that work with tech and an actual ag tech. So in order to qualify for, let's say, for such an investment, you need to be an actual ag tech. And what the parameters of that are, I would not be able to provide with you now, but I think you get a bit the understanding of, okay, there is a difference between these two. And then for us, it's about geography, about how long are you in business? Are you post-revenue? Who are your other funders? Who are your clients? And how, let's say, reliable are those clients? How reliable are your other funders? Where are you getting your other funding from? Who's the founder? Who's the team? Oh, I think it means we're out. So it matters. Yeah. It's based on a number of metrics, let's say. But I would keep in mind for any ag tech that thinks about fundraising, make a very clear distinction between ag tech versus tech enabled.
Tech enabled. Thank you, Tessel. Well, that's all we have time for. I'll attempt to kind of just highlight key takeaways for our audiences. So yes, you can be a lot more intentional in kind of addressing these key priorities of nutrition, climate, and livelihoods. I would end with the conclusion that, hey, focus on what your organization can tackle the most, but be aware of the pressing priorities, be aware of the ecosystem challenges that they assist, so you can actually reflect on whether you can contribute to some or all of the dimensions. We talked about the importance of complementing not only proper financial services with the right features for the type of investments that our clients want to do, but also adding technical assistance. And the technical assistance doesn't only go to the end customers, the SMEs and the farmers. It also needs to support the financial institutions who really need to invest in transforming their systems and their risk underwriting models, right? And lastly, we have tremendous opportunities to leverage on the evolution of digital technology to enable that transformation within financial institutions. Better risk credit scoring models, better MRV processes. We mentioned the ability to pool processes together and so that you can create aggregate loan portfolios for financial institutions that are smaller but but have a big reach. And that is creating progress towards the new challenges of addressing new challenges in the food system transformation agenda. So with that, I hope this conversation has been as interesting for you as it has been for me. Thank you so much to our panelists for sharing this really deep and rich experience. And please, let's stay connected. You can see the webinar recording on our CGAP platform, and stay in touch and have a great rest of your day. Thanks, everyone.
Thanks, everyone.